The third subsection of our chapter will provide an in-depth analysis on the differences between trading and investing. While we had briefly depicted some characteristics regarding investors, let's take a more in-depth approach, as it is very important to distinguish the two. That being said, how can we define a trader and an investor? In reference to our previous section, a trader can be defined as an individual who buys and sells assets for short-term to medium-term gains. An investor, on the other hand, can be defined as an individual who buys and sells assets for long-term gains. Some argue that the trader and investor can be identified under the same category, since both of their long-term objectives are ultimately structured under the same values, which is to maximize profit potential. While this may be true, there is not always one path of travel towards a destination. Some may incur different hurdles, making one harder or easier, really depending on the individual. The path of the trader will often require more of a time commitment as well as an emotional commitment to reach their destination. If we are taking the path in a literal approach, you can imagine that the trader's path involves a lot of changes in elevation, making it very taxing on the traveler. We can imagine the investor's path as one with zero changes in elevation, but is much longer in distance. This means that it will take the traveler much longer to reach their goal, but of course, with little to no effort output. Now, I understand this may be a bit confusing. I find that analogies are often a great way to better express an idea, which is from a different perspective. Really what I'm trying to get at here is that while both traders and investors do want to make as much money as possible, they are much different in regards to their activity level, commitments, decision-making, risk tolerance, and time horizons. That being said, let's put some of these words into examples. On the left side of this page are provided two phrases that your typical trader may observe in regards to their values. The first bubble alludes to the focus on short-term gains as opposed to long-term, which is dependent on the analysis of price action. Remember, a distinct and rather informal way to distinguish between these terms is through the time frame they are working on. As we know from our understanding of different trading styles from the previous section, the changes in time frames typically change the strategies involved. When in regards to the short term, price action is more viable as a tool to trade. The second phrase from our trader here explains the importance of risk management and the preservation of capital. As a trader, it is absolutely critical to protect the money that you already have. Since risk is being taken on a constant basis, managing this risk is one of the fundamental factors to achieving consistency in the markets. Moving on from the trader, let's try to grab some insight into the value system of the investor. The first phrase, as expected, frames investing as a more long-term approach to achieving financial success. We can also determine that this approach will typically be structured under the basis of news and more fundamental reasons as opposed to technicalities such as actual movement of candlestick charts. Now, this is very important, as the more fundamentalist approach is entirely different from the more technical approach that the trader will take. This allows the investor to gain a deeper and more critical understanding into the longevity of a given company or stock, which is much more important for the investor, as they are likely to be committing to a position for much longer than the trader. The trader, as we know, does not care so much as to where price is actually going in the long term, since they are holding their positions no longer than a day, week, or month, depending on the strategy. Still, it is much shorter than the investor, who may hold positions for decades. Some tools or factors that the investor may consider as confirmation signals include company earnings releases, dividend histories, patents, competitive positioning, industry or market trends, and other valuation metrics. The second statement from our investor alludes more so to their long-term objectives and reasoning behind their approach, which is for a steady income source. Often, one of the primary goals of investors is to create or build a steady and passive income stream from their investment. Remember, investing typically won't require nearly as much time, effort, and energy to find success in. It is actually quite easy when compared to trading, but is also something that takes quite a while to begin to reap the benefits from. For this reason, most people typically have their investments in the background, and after a certain amount of time, can begin to start liquidating their investment portfolio. Instead of preserving capital like a trader, the investor will allow their slow but consistent investments to grow as time passes, ultimately allowing them to use it as a means of cash flow. Now that we understand how the values of traders and investors contrast with each other, we can take a look at the hypothetical equity curve for both individuals. An equity curve is a representation of the performance of a trading or investment strategy over time. This performance curve indicates whether the account value is rising or falling. If this curve is above the dotted line, the account value is greater than 0, and vice versa. I would also like to note that I have not included explicit monetary values on the y-axis, as it is not necessary to understand these graphs. What is important, though, is the x-axis, which is a time-based axis using the unit of years. Now, before we begin to analyze these graphs, I want to make a quick disclaimer that these graphs do not accurately represent the performance that you will see or expect to see with your future endeavors in trading or investing. These are simply examples of what a trader or investor may see throughout their financial careers. That being said, let's begin with a trader's equity curve. I would first like to point out that the graph is separated into 4 distinct phases, which I believe most, if not all, traders experience throughout their trading career. The first phase, which I have labeled as the period of confidence, typically occurs during the very beginning of a trader's journey. During this period, the trader will typically experience a high level of confidence. Their confidence may grow substantially to the point where the trader attains unrealistic expectations for themselves and overestimates their own abilities. What's important to keep in mind here is that in nature, humans are egoistic. We often act and behave for our own benefit, whether that be conscious or not, in order to maximize our own well-being. The concept of egoism does not necessarily imply that we are selfish, but more so that we tend to prioritize self-preservation, otherwise known as game theory. At a biological level, humans were designed to avoid bad feelings and seek good feelings. An example of a bad feeling in regards to trading is losing. When our decisions lead to a loss, whether that be financial or anything else, we experience psychological pain and discomfort. This is because we identify very closely with our decisions and our behavior. So what am I trying to get at here? Since we tend to avoid negative experiences, individuals who know very little about trading may only focus on their wins and not so much their losses. When a trader is in this state of euphoria and has no grasp on their risk, they become an extremely high-risk individual. They may begin to increase their position size in order to maximize their profits as quickly as possible. This will often be done with no expectation that a position may go against them, resulting in the given risk becoming realized. Within this period of confidence, the trader believes that they have control over the market and understand it to its entirety. The trader does not believe that they can be wrong, as they haven't experienced being wrong yet. Therefore, the risk being put onto any given trade means nothing to the individual. Unfortunately, this state of continuous growth will ultimately come to an end, which occurs when the trader takes their first major loss. Here's where we begin the transition into the period of shock. During this phase, the trader will typically experience a loss, which forces them to double down on their position, leading to even greater losses. Since the trader has not experienced being wrong before, their fundamental understanding of trading conflicts directly with their own decision-making. The trader will typically commit to their state of denial, where they continue to double down on their losing position, as they are unable to accept the loss. Depending on the mental aptitude that the individual has, this shock period can last until the trader is unable to remain in their position and is forced to comply with the market and close their position for loss. This is the period of shock, which is often where the trader will blow their account. At this point in the trader's journey, one of 2 pathways must be chosen. The trader makes the rational decision of closing their chart, forgetting about the money they lost, and focus their efforts on something else. Or, to commit to the challenge and learn this industry in a much more serious format. Understandably, a majority of the traders will often take the former of the 2 pathways, or essentially quit trading altogether. This is often because the individual has lost all of their confidence in their ability to succeed, which diminishes their motivation to push forward. In most activities that we participate in, there is a positively linear correlation between effort and success. The more effort you put into something, the more successful you will be. What makes trading so difficult is that it conflicts directly with this perception. No one should expect to make less money from something over time, let alone losing money as you learn more. This is unfortunately a common occurrence in trading. The more you know typically does not mean you make more. They say that the universe was designed to reward those who really want something. It is at this point where the trader must make the decision for themselves of whether they really want this or not. To continue along this equity curve, let's say that our hypothetical trader decides to pursue trading and commit to the challenge. The trader is now preparing to transition into the third phase, which is the period of acceptance. During this period, the trader will have to accept their losses and accept that losing is a natural part of trading. This can be a very difficult process, as it directly conflicts with our natural processes that we talked about earlier. Here, the trader will also begin to explore different strategies, risk management tactics, and other niches of information in attempts to find the holy grail to allow them to trade as they had before during their period of confidence. The trader now believes that they are simply missing something that will allow them to be as successful as they were. They will continue to look for this until they come to the realization that their missing piece of information was right in front of them the whole time. It is not a special indicator, type of broker, time frame, style of chart, or strategy that leads to success. It is the consistency and mental discipline that one must sustain through continuous experiences. Once the trader becomes aware of this, they begin to transition into the final phase, the period of enlightenment. The belief system has been completely restructured as the trader has identified and implemented the correct mindset into their system. They understand that it is not the strategy or parameters that the trader has which makes them successful. It is merely the shift in mindset that is necessary within this business. Trading is a game of psychological warfare more so than anything. With enough commitment and focus, the trader can achieve consistent profitability and, after some capital buildup, live a life of financial and timely freedom. Before we move on to the equity curve of a stereotypical investor, I would like to point out an interesting coincidence. The Dunning-Kruger effect is a cognitive bias where people overestimate their knowledge or capabilities in an area of expertise. When we compare the Dunning-Kruger graph with the equity curve for a trader, we can see many similarities. In regards to the data line, we can see that both graphs open with an initial rise, followed by an equally as aggressive fall, which is then followed by a slow and steady ascent. So what does this tell us? The Dunning-Kruger graph on the left measures the correlation between our confidence and our understanding of a subject, while the equity curve on the right measures the correlation between our profitability over time. When combining the information between these graphs, we can begin to understand that knowledge does not equal profitability or success. Notice how there are multiple data points that correspond to the same value on the y-axis. If you were to consider profitability or success as having made money, then you can be profitable or successful even when you know nothing. This can be seen in the beginning of the graph of the trader's equity curve on the right. We can see that there are two phases within the equity curve where the trader is quote-unquote profitable or successful, even though the knowledge or time that they have has been different. As we know, this beginning stage of the trader's journey is deceptive, as the trader really is not profitable, at least not consistently. I also want to point out an interesting concept in regards to our confidence as traders, which would be easier to explain through a scenario. So let's take golf, for example, an activity which can be enjoyed by people of all ages. A young individual, we'll call him Tom, was first introduced to golf by his dad, who had played professionally. He continued to play throughout grade school and was able to make the varsity team at his local college. One of his friends from college, Jerry, wanted to play, so they booked a tee time at one of their local courses. After the round, Jerry had developed a decent understanding of the game, which made him excited to play again. When looking at Tom and Jerry from face value, you may consider them to have a similar level of confidence, even though their understanding of the sport varies to a strong degree. This is primarily due to Jerry's ignorance, as he has not been exposed to the complications of golf, such as club selection or course etiquette. Instead, Jerry understands the basic fundamentals of golf, such as how scoring works and the differences between clubs. Like most activities, there is often complications which can only be understood after enough time or effort has been invested into that activity. So what am I trying to get at here? Confidence is not an indication of success, and neither is profitability. If you are profitable or see others as profitable, that does not mean that they are successful. Success in trading comes from much more than making money. So what does this success come from? Success comes from competence. Also note that competence is not synonymous with knowledge. Knowledge refers to the information that the individual possesses, while competence refers to the ability to apply knowledge in order to perform efficiently. So, if there is any secret to trading, it is this: you must not seek knowledge in order to acquire success. Instead, you must seek competence. I understand that was a bit of a tangent, but it was an important one, and I think it is very appropriate for this chapter to discuss. Now, let's take a look at the investor's equity curve. But before we do that, I would like to point out that once again, the financial gains or losses on the y-axis is going to be left unknown and will therefore not provide an accurate representation of what is to be expected when trading or investing. These graphs were not created with the intention of being accurate, but simply as a hypothetical example to help visualize their primary differences. I would also like to point out that when looking at the investor's graph, the x-axis has changed. Remember, the x-axis is in units of years. Notice that the investor's curve is referenced over a span of about 40 years, while the trader's curve is only on the basis of about 4 years. This is to help express the differences in time frames that you must consider when trading or investing. So, when looking at the investor's graph, we can see that there is virtually zero downside. This is because the US economy typically realizes a growth of about 8% every year, adjusted for inflation. When compared to the trader's graph, we can see that there is the potential for a lot of downside. In reference to our previous section, we understand that trading requires a huge effort and time commitment, as opposed to investing, which generally requires zero effort. Throwing your money into the S&P 500 will virtually guarantee profit. This is not necessarily the case for trading. Trading is an entirely different endeavor, which carries huge risk potential. Now, this is not to discourage you, but to inform you about the differences and how important it is to take all financial opportunities into consideration. And if at all interested, I have quickly displayed a diagram which provides a slightly more accurate representation of the differences between these equity curves.